Hey everyone, this is Michael Bengia. This is the Stock Picks weekend video for July 30th, 2022. Here's our disclaimer. You can pause the video and read this. So as usual, we're going to get started just reviewing the current market environment. We're going to look at the stocks in our portfolio, and we're going to then look at the stocks in our watch and ready list. So going back to the environment, we've had a really big rally in the market. The whole tone of the market changed from a market trend advisory service. We went from pretty mixed picture with some selling in the indexes to by the end of the week we are solidly green, 100% invested. Everything looks good. Very few institutional selling days, which are days where you're tracking what the institutions are doing. So it's looking very, very strong, and that just really changed in a few days. Markets decided to kind of brush off any concerns about inflation or recession, things like that, or rising interest rates. So that's really good. So that's something that is one part of the whole picture of stock investing in terms of for individual stocks. But what we're seeing though, while the mega caps were really driving this and a lot of the beaten down tech stocks, a lot of other leading stocks, those are stocks that are near at highs that they're just not working as well. We're just seeing a lot of breakouts. They fail, they don't go anywhere. And we're seeing a lot of volatility around the buy points. So we're just not getting much traction. So we keep saying, it's almost like a broken record, we continue to hold off on adding any more exposure till we get some progress across our open positions. And we're just not. So let's go ahead and just go straight to the to our positions. So let's take a look at what's going on here. Okay, so let's start with Eli Lilly. This is one that we bought. Let me go back. This is a weekly chart. Let's go to the daily chart. So this is one we bought when it was breaking out of this little thing and this little consolidation area. And you can see it just hasn't gone anywhere. It's just been kind of vacillating in this area. And the relative strength is starting to actually pull off a little bit. Still very, very strong at 96 out of 99. Yeah, we see this kind of pattern we're seeing a lot. It just can't seem to make any progress. Earnings are in 5 days. And a lot of times, stocks will tend to run up into earnings, and we're just not getting that in this case, unless maybe on Monday and Tuesday it decides to take off. But this kind of a pattern, we're just not getting any traction. So we'll see. So what we usually do, though, if we haven't got any gain, like right now we're actually down 0.55%. We have a small position. But we may do, if we just don't have any gain going into it, we'll probably exit the position just to avoid the risk of a major down hit or something. You just never know. And these days, we're getting big ones, big moves, gaps up, and big gaps down on earnings. So we'll just take the risk off, do that. But that's it's the company looks good. You have good sales and earnings. The fundamentals look good. Technicals are good, but we're just not getting any movement there. So let's take a look at the next one. Now this one, we only have 3 positions. Because again, with the market doing what it's doing, we just don't want to have a lot of exposure. Excuse me, 1 second. Okay, sorry, I was losing my voice there. So this company, Stride, ticker is LRN, they provide online curriculum to K-12 students. This one we bought breaking out of this consolidation, had a little move up, got hit with some selling, not enough to kick us out. And on Friday actually broke out to new highs. So it's a great sign. So we are getting a little bit of traction on this. We're up 5.5%. We're not really up enough to really take any profits or anything. But it looks pretty good. I mean, the volume though in this last few days in the breakout is really, really low. A little bit of a warning sign there. Let's go to the weekly. Weekly, yeah, unfortunately, as it's going higher, the volume's going lower. But it doesn't look bad. I mean, we just have to kind of keep an eye on that. Earnings are in 10 days. So we'll see. If it continues going up, we might take a little off the table in front of earnings. But earnings have been really strong and consistent for at least the last 2 quarters in terms of also with margins. So we'll see how it is. But we still have 10 days to go. If it really makes a nice move up, we'll take some off in front of earnings and let the rest ride. But also it's got very strong earnings growth, composite rating 98 out of 99. Growth rate's really good. It's starting to break out to more annual earnings. So it looks really, really good. We do have a small position, but we'd rather have a small position in something like this than no position. So that's the only one that's sort of worked out so far. In our long-term outperformer portfolio, we do own Humana, and we're basically, we're just up 0.5. Same thing, just like Eli Lilly. It just can't really seem to get anything going. If anything, we're kind of forming maybe a base on top of the base. So really, but again, stock looks strong, breakout years in earnings. Now we're in the mid-20s. Annual earnings, looks like we're going to be heading above that. I mean, all in all, the stock looks really strong. Let's look at a weekly. Yeah, I mean, it's been a choppy trader, though, for the last year. But one thing we do like is that it was in a big consolidation here, and then we finally broke out above consolidation. So that's actually a good sign. The longer the consolidation is, and then you finally break out above that, it's a very good sign. We've had then, you can see here, 5 weeks up in a row, all closing up near highs, or in this week, they were actually real tight closes from the previous week. We had a little bit higher volume sell-off this week, but the stock was able to close in the 46% range, which is actually a sign of accumulation. So nothing really no warning flags yet. Earnings did pass by. They didn't really do much for the stock. We actually had a gap down on the earnings, but we've sort of recovered. We did move our stop right below this day here because really after earnings and that it sort of made a low and closed up. It's 21 day, this green line. It really shouldn't break now below this day here. So our stop is right around there. If it does that, then probably it will continue quite a bit lower. Okay, so let's now take a look at, let's see, the ready list. We have just 3 stocks on here. First one is McKesson. Ticker is MCK. You start seeing the same names over and over on the list because these are leading stocks. And they're all really just, in fundamentally strong numbers. We have strong technically, even though we're kind of been just struggling to get past this area. You can actually see whenever the stock would get above, let's see, around here, it would pop above a few times and we started getting sellers. Now, but one good thing that we're seeing, let me go ahead and just draw a line here. Okay, so we're starting to get rid of a lot of the selling resistance. So you can see here, we had a nice long run in the stock. So we like the fact that the stock does have a history of making a really nice move. This was, about 70% or so in just, about 6 months. That's a fantastic move. Then we ran to some just consolidation up here. You can see about around 335, whenever the stock would get above there, sellers would appear and knock it down. Again, it came up here and really knocked it down, came back up, couldn't get past that. But notice what's happening. We're actually cleared that area. So now we're actually floating around in the area where it used to be a lot of sellers, and the sellers are no longer appearing. So, and we've had 7 days up in a row now. So that's actually a really good sign. And we got support of the 50-day, which is this red line here. So that came down. So the stock is acting well. It's just not going anywhere as we'd like to see a nice, really strong breakout. Now, earnings are in 4 days, so it looks probably on Tuesday they'll be coming out. It's one of those ones, this is what's happening. They tend to move right into earnings, and you don't want to buy it in front of earnings. So we may have to just continue to watch this, even though it is on the ready list. The buy range is 340 to 350. So really, we're actually, our buy, we moved it up to just above this top here. So we've just entered it on Friday. We've had a little bit of struggle up there, but not bad. But we may just have to hold off on that one because of earnings. Unfortunately, this is earnings season. This is what happens. Cigna, another one, earnings due in 5 days. A little tougher one. A lot of volatility, which we don't really like, but it's starting to tighten up here. we had big move here, we had a move here, then we're getting a smaller move here. Actually, even better would be even a smaller move. So in other words, you could see like you're going, see if I can draw this here. So we have a big one here, another contraction here, and then we would actually get another little one. That would be a really good sign, especially at the highs where the sellers were always coming in and knocking it down around 270. So we seem to have gotten past that, and the sellers have just sort of moved on. Who knows where they are? But we'll see. But 5 days earnings, we're sort of probably pass on that. The last stock is Humana, which we already looked at because that was in our portfolio. So let's now go to those stocks for watching. Not a lot. Well, the first one is Eli Lilly, which we own, so we'll skip that. The next one, because we just looked at that. Next one is Vertex, and the ticker is VRTX. This stock really has fantastic fundamentals, and it's just been struggling a little bit. Again, another stock that has a history of really making very, very strong moves. We like that. Throughout this whole bear market, this is the S&P. So you can see that it's look at the S&P coming down, coming down, coming down. Now the S&P started to come up, and this is now going the opposite direction. It doesn't mean anything really in the long picture, but the important part is this has been outperforming the market for a long time. It was heading higher throughout this whole bear market. Now, of course, it could be that just the trading, mega caps are popular again, the beaten down techs, jumping back into that. So it could be that just temporarily the stock is, I guess, pausing out here. But, let's go to the weekly. Yeah, I mean, it had a really nice run. For whatever reason, from 2020 to 2021, stock didn't perform, but we're back up at new highs. Let's look at a monthly. Yeah, this has been a nice performer over the years. Maybe a little choppy at times, but so this wouldn't really qualify for our long-term outperformer. It's too much volatility along the way, but stock does look good. It's also in the biotech realm, and that industry group is now 5 out of 197. So, you're seeing money is flowing into some of these stocks. Look at a couple other things too. We're also getting some of the bigger, better funds like Contra Fund has a position here. MFS Growth has a position here too. So that's a real, these companies, they do a lot of research. They have a lot of analysts. So when they're putting the money in there, they're seeing things that they like. So we always want to be riding on the coattails of the best funds. If they're buying it, we'd like to be buying it ideally ahead of them. So they're pushing it up after we already own it, but of course that's not possible. But we want to be along the ride with them and hopefully getting out before they decide to get out, because we don't want to be part of that. Okay, let's take a look at Amdocs. That's a new one we just added. Ticker's DOX. They provide business support software. Again, you can see that it's a little choppy. This is why it is on our watch list. But it's coming up to new highs. Let's go back. Let's look at a weekly first. Yeah, so we're starting to break out. And the RS is really starting to come up since the end of last year. So a great sign. Sales and earnings, little spotty. Nothing to write home about, especially in sales. Just single-digit increases. Good earning stability. When you have a 2, it means that this company is just known to be a very consistent earner over time. That's a nice thing. The fundamentals are pretty good. The ratings are pretty good. I wouldn't say this is like my favorite stock. Also, it's just too choppy. We need it to get back up around 87, 88, and see we're already kind of tightening up here on low volume. Good sign. We'd like to see that get up over maybe even up here. But we do have earnings in just a few days, so we just have to watch that. All of these, except for the next one, AstraZeneca, have earnings in less than a week, so we're sort of stuck there. So AstraZeneca did have its earnings up 110%, sales at 31, really good numbers. Stock didn't move on that, so you have to kind of wonder. It was already priced in. Guidance was maybe offsetting that, who knows. But the stock just really didn't do anything. And we're in that same kind of consolidation. You also notice that the healthcare industry, we saw Humana, Lilly, There's been Merck, there's been AstraZeneca, a couple other ones. Interesting though is that they were acting really, really well, and then all of them sort of now started going into a consolidation. For whatever reason, maybe just because the money's flowing back to tech, but looks still pretty good. At least earnings are out of the way. Who knows? We'll see. Maybe this will even tighten up even more and give us a chance to buy it. But that one is on the, at least there's no earnings, so we can take a look at that. And the last one is Royalty Pharma. It's a company that owns pharmaceutical royalties. So as you can imagine, a company like this, their earnings and sales are always a little erratic just because you're probably based on getting royalty payments. But we can see that for annual earnings, it is slowly but surely increasing from $1.50 to $3 to $3.50. It's got overall a good composite rating. It's been a choppy trader, and it's just now gotten above its 200-day. But you can see it's starting to tighten up here around the 40s. Take a look at the weekly. So this is actually a pretty recent IPO, which is good. Some of the best movers are companies that have IPO'd in the last 10 years. So this one is even less than that. We're only talking about 2 years this has been around. So the fact that it's typical, comes out, plunges. If you look at most IPOs, this is the pattern. Down it goes. Then there's usually some kind of rally. This one just traded down a nice. It's forming a cup base here, starting to tighten up over here and form a first stage base. But it is a choppy trader. We really need this to start tightening up and give us a better side up for here. But we know the overall, you kind of see the look of this. It is forming a cup, even though this is calling it a consolidation. But you can almost see a little cup here, and then it's forming a handle. So we'll see. This is something we're watching, but it has appeared on our list. But earnings are in 5 days, so we'll probably just continue to watch it. That's all the stocks we have. There's just not a lot of real strong stocks that are not been gapping up or, making them really not buyable. So it's kind of slim picking still. It's been that way for a long time. And we'll just wait. Of course, we're just going to be stuck with the earnings. Some of the ones we're watching, they'll probably gap up, and that's the end of that. We don't usually buy gaps. It just adds to the risk. And some will gap down. That will be the end of that. Some of them really looked pretty good. To FCN, this is one that we had really good, strong numbers and everything, but it just, the earnings just disappointed for whatever reason. Market didn't like it. This was a nice leader. We were hoping was really going to perform well. We were looking to get into it. Had already broken out, but didn't work, and also dropped its RS rating down. So, anyways, these stocks you'll see them come back up because whatever reason, unless it was horrible earnings, it'll come back up and probably try to form another base. So that's why you see the same names over and over, because they're leaders, and all we're trying to do is get in those leaders at the right time, at the right price, just breaking out of some kind of base or consolidation, or even possibly on a pullback where where it breaks out, a couple of days pulls back, goes up for a new high. We try to sometimes buy over there also. But this has been very volatile these last few months, just because we're in a bear market still. This also makes it more difficult trying to find the leaders. They don't just take off as they do in a bull market. There's a lot more breaking out, coming back, backing and filling, making a nice run, then pulling back, wiping out all those gains. This is why we've also had on our overall environment, best strategy is swing trading. Because really, for the last year and a half, you've been pretty disappointed if you've been trying to hold for big moves. You just haven't got them. This is real typical. You would buy here. It would immediately test you, maybe even stop you out. It looks like this one probably wouldn't have stopped us out. But you get tested immediately. You get a nice run up. Looks like it's going to be fantastic. In fact, this is going into earnings. You would maybe have sold it into earnings, and that would have been really, before earnings, that's a nice sell signal. And really taking your profit here. But if you didn't, then you get the plunge, and then you're back to zero with a lot of volatility. This is very typical. Then you're trying to get in again. Again, you buy another breakout, fails, stopped out, then it takes off, it looks good, then you have another fail. This is just typical of what's been going on in this environment because it is a bear market. That's what happens. It's not an easy environment. Though you will, whether or not we're done with the bear market is debatable. The market's acting like it's put in a bottom, but nobody really knows at this point. But out of this bear market will come some new leadership, not the old tech stocks, the trade desk and all the mega caps, Amazon and Netflix. Those are probably not going to be the leaders going forward. But there'll be some new names are coming up, and they will turn into the big leaders of the next 10 years. So we're always just trying to find those. And they usually look really good before they take off. That's why we're always looking for strong fundamentals as well as technicals. But there's sometimes, in that process of bottoming out of the bear market into another better environment, you get a lot of volatility, which acts. But at some point, it will quiet down. Ideally, this market will maybe pull back a bit, and that will let a lot of bases form their right sides, and then we'll be able to actually find some true winners. But that's what our goal is, to find those. And then, of course, with the new bull market, we can hang on for a much bigger move and get some really nice gains. So anyways, we're not there yet, but we're on the prowl for those names. Okay, that's about it for this week, and we'll be back next week. Okay, thanks.